Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session, latest mid-session update for Monday, October 20th, 2025. It's 2:31, so we have about an hour and a half left in the trading day. And here's what I'm going to go over in this order. We're going to start out with the VIX. I've been covering that quite a bit lately. It's an active trade idea. And then the very, very extremely close related stock markets. We'll do a brief overview. No reason to do a deep dive. Just give you an update there. And then I want to roll into Treasury bonds, something somewhat closely related. I think it is time for the next trade on Treasuries if you're interested, or just keep an eye on them because I think rates are going to go up from here very soon. I think it's time to short Treasuries and just pretty much all bonds across the spectrum. So something I believe is about to happen, whether it's something Fed's heading into blackout period, so really can't expect much there. Government shutdowns in full swing with no end in sight, so we really don't have a lot of data. All we have this week are the a bunch of earnings, some important earnings coming out, and I'll talk on that as well, especially regarding the stock market. So, all right, time permitting, I'll also touch on energy. Crude oil, nat gas. Nat gas continues a rip following last week's that false breakout whipsaw signal on Friday. So we'll see if we can get to that. Okay, lots to cover. We'll dive in here. This is VIX, the VIX volatility index. And so let's start with the original setup I gave you back on all the charts, always time and date stamped back in on September 12th. So a little over a month now. And this was a setup, one of the best setups I've seen in a while. We've got all these spikes that the VIX has had in the last few years, usually just getting in. And the technicals are pretty much going to be an inverse of the technicals on the stock market. In other words, I like to buy the VIX for the same case I can make to buy any stock. I like to buy it at pullbacks to support, especially the low end of the trading range, positive divergences, and then breakouts, ideally above bullish chart patterns, resistance. So back then, we were at the key uptrend line support. As I mentioned, the stock market was punching through, making marginal new highs, yet the VIX, unlike it, was not making new lows. It was making higher highs and setting up. And then you can see your targets were right here. And this is the one I covered with a big one right there in blue. That's why it's color-coded. Very, very important level, 2192. Let's just loop back to the VIX. So we took that one out after two tags on it, punched through it, and had one of the biggest days in a while, all the way up there to that 2862 target, which was right here. You can see all these levels are given in advance. 2862, also a big level, and so we hit that last week. I always say if you're trading any of the VIX tracking ETFs, even the futures, you want to watch a spot VIX, you also want to watch the futures. That's what matters. And so we hit those targets then. And again, almost a perfect tag. You can see the body of the candle close, hit right around that 2862. Split the crosshairs between the top of the body of the candle and the top, the wick there, the high. So, and pulled back as expected. Now let me just cover this. Remember, these are key resistance levels. You can't really make this stuff up. All these levels were highlighted in advance. Reactions off each one, tradable reactions. 27 was my next target. Parked there that day, and that's a reaction when you're going up and you close on a level. That's also a reaction. Then hit that one. So let's talk about the pullback. If you're short the VIX, if you're riding out the pullback, doesn't feel good on that position. Hopefully you're diversified, but let's again talk about that. That's why I do these long-winded videos. And so far, it's just a run-of-the-mill pullback. I'm just going to go back in time here a little bit as we look at the VIX. And we can see there's been periods with these big runs. I have even higher upside targets on this trade this time around. But you come off these divergent lows, and what happens? And as I said, sometimes these are one-off events, and then you go down to new lows. But quite often, you get that first, what I call shot across the bow, and it is far, far, far from unusual to have a near 50% or better retracement. That was the initial pullback right off that first pop to the same level from a little bit lower. So it was an even bigger pop in the VIX, pulled back there. And then what happened is the VIX held above the breakout point and then went on to finally go up there and hit that 60-14 target. I believe I had that one back then also. I can't remember if that was part of that trade. That actual level, if I moved it then, I believe it was still there. We can go back and we can reference those charts later. This one here, you can see we were building support. Building divergences. We did get a little pullback about day 2, and then the VIX exploded there. Very quick move up. This was one of those kind of one-off, but all part of the same big divergences. A comparable pop to what we just had. The VIX went on to make a marginal new low, and still very much divergent low. Okay, I had to pause it there for a call, and it took a little bit, so I forget where I was at. But what I wanted to show you is, again, keep in mind that quite often, but not always, these one-offs, again, what I was referring to as a shot across the bow, especially when the technicals confirm, are usually followed by a pretty sizable retracement. All it takes, especially when the market's at or near highs, 52-week or all-time highs, it just takes that first dip buying rally to cause the VIX to melt down like that, because then everyone's wanting to jump back in and don't need to put protection. So, but at this point, again, we're still well above the breakout point, and so far a typical run-of-the-mill retracement. But as I like to highlight, there are times where you get that. And it may take, in this case, it took months. We didn't go much lower below that breakout point. But if you are trading things such as the VIX ETNs, they are prone to decay due to the expenses and the rolling of the futures they have. And so you probably won't want to give it too much rope. I'll tell you in a nutshell, in the QQQ trade, which I'll get to in a second, I'd said we put in those bearish and call things last week before Friday, both the daily and weekly, and my personal plan was stop somewhat above those highs. Again, somewhat is relative. We're getting close today, but we have Wednesday, I think, is kind of peak for the earnings this week. We're going to have Tesla and I believe Intel as well on Wednesday afternoon. So my plan is to just sit tight on everything at least through Wednesday is regarding positions on the market. Market positions are also the VIX, and because it's inversely correlated with the stock market. Just to go back here a little further, I have to go all the way to the edge there. You can see this is the last big drop just before COVID, and the same thing. You see we had a very similar, we're at long-term support. You had that first pop up, which was comparable in percentage terms, roughly to what we just had, and a nice healthy retracement, more than half, just like now, and then you get the next wave up. So that's still the scenario that I think is most probable, but I know it just bears repeating that sometimes you get these one-off kind of moments, and you, in that case, if you're willing to sit tight and you had futures and you were rolling them, there's minimal expenses, even the ETFs. Let's go to that real quick, and then I'll move on. That is, so I already covered, that was the spot VIX back on the 12th. And I also then followed up with the official setup, the VIX ETF proxy, because I know most folks here, the majority of retail traders don't trade futures, they trade these ETFs. So I'll use this as a proxy. And I also gave you the chart for the futures, and that's looking the same. It's close, more closely tracks the spot VIX. And that's it. So we got our, this was the setup back on October 1st. Long entry to come on a break above the bullish falling wedge, that downtrend line, with a secondary buy signal to come a break of R2. And you had 1, 2, 3, and you still do 1, 2, 3, 4, up to 6 potential targets. First one was hit. That was October 1st. Today is the 20. What did I say? The 20th, I think. Yep, 20th. And there's VIXY. Then we'll move on. So pretty much playing out as to be expected. Now, the million-dollar question, was it a one-off, and is that going to be the only target hit? Or are we going to have another leg up, and are we going to have it soon? So let's talk indexes. and then we're going to talk bonds next. So again, QQQ on both this daily here and the weekly time frame. When you look weekly, put in those bearish engulfings. There's the top of the bearish engulfing candle from a couple weeks ago. So we're getting close, not there yet, but very close. And again, the suggestion was on that bearish engulfing. Remember, the short entry came long before it was finalized on the break of the primary uptrend line. But for swing trend traders taking that, at least to stop somewhat above there. And again, you might want to factor in the market's pretty much in a blackout period. Virtually very little economic data. Feds are going to be going into their blackout period as they always do, leading up to an FOMC meeting, and so it's really earnings are probably the biggest news catalyst, other than POTUS, firing off his whatever tweets. People are starting to ignore him. The president, whatever is becoming almost irrelevant as far as his tweets, because nobody takes him serious anymore. Continues, the taco trade continues. And so, again, there's the potential, depending on what he says or does. But those are omnipresent, movers, unforeseen market movers. In other words, you can't predict. They're kind of gray swans, if you will, or even more so than that, really. You're going to continue to get kind of crazy tweets or whatever you call it on his Truth Social thing coming out of their statements from Trump. All right, guys, so that's it. Let's right now, those sell signals are intact. We're still comfortably below the trend line. As I've mentioned, we could easily go on a back test of the trend line. As I said recently, you probably wouldn't want to ride out short, especially as a holder of the VIX, because to get there, trend lines are dynamic, meaning they're coming in every single day. The price comes in at a higher level, higher price point. So if it took a while to back test it, if we did it really quickly, here I have to extend it. This is the primary uptrend line. If we did it really quickly, we could get there in a day or two. Otherwise, it could take a while to get there. And even then, there's no guarantee that if you backtest, you're going to get rejected, or that you're going to get rejected on the first try. But again, to reiterate, nothing has changed technically. And a lot of the previous market tops, when we had sell signals, trend line breaks, there's a lot. I'm just pulling back to this one here. This was a lesser trend line, not as significant, but still a pretty good one. Let me see. Yeah, that one goes back. And there's an example. And sometimes you break trend lines and you go straight down. Sometimes you move around for a while. You'll go up above the breakdown point, remain below the trend line. That was off a divergent high. That was your sell signal. And then it started to play out afterwards. So, all right, enough on the market. Let's dive into bonds, because bonds also can impact stock prices. So if you go back the last couple of years, I'm not going to say we batted 1,000, but probably 800 or better on trading bonds, meaning the trade ideas I've gotten out to you, both in videos as well as the screenshots with the targets, have been, mostly winners. Very few losers, and even those usually tight stops. This is the first setup right now. This is what you're looking at is TLT. It's a busy chart. I usually like the cleaner charts, but I have a lot of lines and levels I just like to leave on this one. And you can see TLT trades so flipping well to the technicals. These are divergent highs and then sell signals to follow. You can see before that we had a long trade here. We must have been long off that divergent low. There was a breakout right there. T1, second target hit, then put in a divergent high that ended that quick, powerful uptrend. Went down, put in a divergent low. We rallied up to this divergent high. There you can see that nice, I'm drawing just the wedge using my arrow tool. There was your sell signal, a breakdown. We went down. Little divergent low gave us a bounce. Another divergent low there, rally up, divergent high, divergent low, and that divergent low, which was highlighted back at the time, has carried the 30-year. This is, again, TLT is the 30-year Treasury bond ETF. It says 20-plus year because they're trying to track the 30 and they're constantly rolling. They can't keep putting, every time a 30-year bond now has 29 years left, sell them all, you'd run expenses up. So they're Again, trying to track the 30-year bond, and some of the bonds might have a little bit shorter maturity, but they're all long bonds. And that's it. So this is the first divergent high. Now, I always say, quite often, divergence is not a sell signal. Let me repeat that. Divergence, just like overbought, is not a sell signal, but it is a condition that more often than not will precede a trend change. And so I like to go down to the 60-minute chart to hone in on those entries and exits. And this is what it looks like here. Again, you can see nice divergent low breakout. That was when we traded a little divergent high there, divergent high there, divergent low, targets along the way. Sometimes I'll give you charts of the futures, which I'll get to in a second for your futures traders. And that's it. So most recently, if we zoom in nice and tight here, you can see we had let's run up, little divergent high on the 60. 60-minute chart's probably my favorite swing trading time frame. And so we put in a little divergent low, had a little bullish falling wedge breakout. I believe that was highlighted on the site recently. Oh yeah, it was. Actually, because I gave you right here as a trade idea for a fade right back to this level, telling you that was a breakout right here, pretty powerful, and gave you a short trade idea right here on this wedge break. And we had that went slightly underwater, like things always do, just like the stock market now with a breakdown of the primary trend line. That was Fed induced, marginal new, but still divergent high, and didn't even come close to exceeding any reasonable stop for that sole price target. Hit to the button, and then time to reverse, divergent low, and we've come full circle. And there's your near-term trend line. If you don't want to be that second mouse, you're the first mouse. You want to be the second mouse that gets the cheese, not jump the gun. You want to wait for this trend line to break. I just tightened it up for you nice and tight there. That's it. So trend line off the recent lows, 60-minute chart, divergent high. Where to? To be honest, I haven't. I'm going to move these lines now. That would be a minimum target right there, and that's 86.93, 89.93. That's the actual support level, so you want to cover a little bit above that, and then quite likely back down to the this level once more. Again, it's not a big trade percentage terms. They never are. Treasury bonds are inherently low volatility. But because of that, it allows you to take a much larger position size and not lose too much if it goes against you. And therefore, you can make it worth your while. I usually say at minimum twice, sometimes 3-4 times what you might trade on the S&P 500 or QQQ. And that's it. So we're coming up to, do I have resistance here? No, don't have resistance. Oh yeah, on the daily chart, a little bit right there. So we're getting close. Let me look at the futures for you, and then we'll move on. Okay, this is ZB for you Treasury bond traders. We happen to be looking at, let me move this down so you can see it. We happen to be looking at a 6-month chart with 2-hour candlesticks. You'll look similar on a 30. There was a little wedge right there, breakdown, little divergent low rally. And this divergent high that was right here has extended, meaning the indicators continue to make lower highs with prices making higher highs. There's a little minor trend line that will trigger a sell signal. There's first target right there, secondary trend line, and then this more significant trend line down here, which also comes into that. That was that last short pullback target I gave you as well, that just above the 115, 220-ish level right there on CP. So again, you may not want to trade bonds. I don't get a lot of comments on those trades, very few if any, but keep in mind that should that happen, for whatever catalyst, whether it's just organic, natural market forces, or something is said out there in the markets, that would most likely put pressure on stocks, particularly large cap, the small cap stocks. They're more rate sensitive. Not a little blip, but if we make it all the way back down here, and then some, maybe we go more. Let me go through all my bond holdings real quick. My bond fixed income. I have a watch list with various fixed income ETFs and treasury yields and all that good stuff. This is MUC, California muni bonds, putting in this little trading range, stalling out here about at resistance. I don't have much of an opinion on that. I watch California because I do believe there'll be at some point in the near future a big shoe to drop there when you've had that trend which continues. I've read about people continuing to flee that high tax state, oppressive oppressive tax rates, and a lot of folks moving out of there, not wanting to pay those taxes, and that's going to you're driving the the earners in the state. We got a lot of people that are living on the dole that don't pay the taxes, so it doesn't matter to them. So that's something that can't continue at that trend if you keep running off, especially your higher earners that are paying the bulk of the state income taxes. And then don't even get me started on the when the next shoe drops, when the next true bear market comes. And unless you're a believer that they've been banned and now the Fed's finally figured out and prevent all recessions and bear markets going forward, if that's your thing, you load up. Take every penny you can borrow, mortgage your house, sell your children, and put everything in a leveraged index fund if you believe that the stock market will go forever. If you believe that things work in cycles and excesses create bubbles and bubbles pop, then the next big bubble we'll see unwinding of things, including and not limited to private equity and private credit. That's now becoming in focus. I've been talking about for a while, and we know that pension funds, CalPERS in particular, world's are the biggest in the country. Public pension fund has put more and more money into private credit, private equity, and they've the majority of public pension funds in the U.S. are grossly underfunded, and that is the responsibility of the California taxpayers, any shortfall that they have ultimately. And they have those shortfalls. They're keeping the pension checks coming for now, but if we go through a prolonged bear market, like myself and a few others see potential for a decade-long plus secular bear market, then that's sooner or later those problems are going to come home to roost. So we'll watch California. I do closely, and right now they're not they're showing a little few cracks, but nothing big. That's just the high yield inverse or the short high yield bond ETF. I gave you that too as a trade idea the other day, because long-term bonds have finally broken down. Junk bonds have broken down, fallen. I covered all these the other day. I'm just going to rifle over the charts. I don't want to spend too much time because I did, on request of somebody, one of the subscribers asked me to talk about the various bond classes and how they can affect the stock market. But here's another PCQ, California Muni Income Fund, and it's confirming. So the reason I'm doing this, guys, I just want to say I went through these charts, and just about all bond asset classes from the Treasuries, which we started with as the trade idea, but as well as investment grade and junk grade, low grade corporates, as well as munis, are all kind of singing the same song, if you will. They had PCQ had a nice big, bullish falling wedge, beautiful breakout, but that looks like to me like it's run its course. It's at resistance, big old gap resistance here, very significant resistance, bearish rising wedge. So once it breaks that, we'll probably get a correction. And remember, guys, the bond ETFs and bond funds are the price of the bonds, which move inverse to the rates. So to be bearish on any bond or bond class is to be bullish on rates in that class. Rates go up, and with the prices falling. HYD, this is the Muni Custom High Yield Composite Index. So this tracks high yield muni bonds. Those are your lower rated ones. And again, just nice little setup here. So that's why I wanted to do the video. It wasn't just TLT. I don't like to force trades. If I look at TLT, government bonds, but yet most other bonds look pretty good, and I can't make a case to short those soon as well, then I just move on. MUB, this is my kind of go-to iShares S&P National Municipal Bond ETF. So this one ETF kind of gives you an overview of the entire national muni bond market. And you can see we've been in this range here. We're getting near the top of the range. So if we go up a little more, it wouldn't surprise me at all, because it's very common. The typical MO is short the top, short or sell if long the top of the range, top. And then the next stop is usually the bottom or very close to the bottom of the range, right? And we already hit that. So we're getting close. It would be a little atypical, but there's a time we reverse. But we're also coming off the high. And it is resistance in itself. These are all resistance lines. However, this uptrend line is your primary uptrend line. So right now, I'm not looking for a moonshot trade. A moonshot trade would be a drop back down to the bottom of the zone. Just a correction, quick trade there. again, here's your uptrend line. It's nice, clean, well-defined. Break of that trend line, set an alert. The more of these subcategory bonds you see trigger sell signals, the more likely the sell signal in treasuries or whatever you want to trade is going to stick. SHY, very short term, even the short-term yields. Remember, the Fed is widely expected. I think it's, again, like a 100% chance Fed's going to continue to cut rates, or very high. But yet, these are your shortest-term bonds, which will usually, they go up when short-term rates go down. But I can tell you they're at resistance, negative divergence. No sell signal on this, but there's a trend line. And you really got to lever up on short-term bonds. They hardly move. So it wouldn't shock me to see these continue to go up, because sometimes you will see, especially if the Fed, the thing about the markets, this is 1 to 3 year bonds right here, 1 to 3 year treasuries. Most, if not all, of the next rate cut, unless the Fed, something big happens, the Fed really comes in with a more aggressive cut. Let's say something in the financial markets blow up, another big bankruptcy, like we've already had 2 big ones recently, a private credit problem, anything. I've been highlighting all kinds of things in the financial sector. Yeah, that could cause short-term rates to drop with another Fed cut. Bigger than expected, yet long-term rates could still back up. It all depends. So this is IEI 3 to 7 year. I'm just trying to give you a picture of the whole yield curve, if you will. And this is, so I've covered short-term treasuries out 1 3 year. This is 3 to 7 year. And again, they're all setting up in a very similar technical posture with negative divergence, and no guarantees, guys, but I'm circling every divergent high on this ETF in the last, we're going back to 2023. We can go back as far as we want, but that's it. And that was, by the way, that was a divergent low. Sometimes these don't all show it there. That was a divergent low. I don't have the DLs drawn in, but divergent low right there. So again, my point is, they're easy swing trading vehicles, and nothing is ever 100%. Some of these trades won't pan out, but you just look for the divergent lows, divergent highs, and wait for the sell signals and swing trade it. And it's a way, again, to diversify your holdings. All right, a few more, and we will move on. Let's go to HYG. Junk. This is one of the junk bond ETFs, as I mentioned recently, just broke down below the uptrend line. Right here was our sell signal, still well below it, and no change there. So I think we'll probably see another leg down in the junk bonds. Let's see, SPHY, high yield bond, another high yield ETF. The more I can look at, the more it kind of gives me a more comprehensive view of the overall sector. Because if you go with any single one ETF that tracks, let's say junk bonds, maybe they have a huge holding in one position that's really going down on them, and that causes a trend line break or the chart to look more bearish than the overall sector. So I'd like to look at as many as I can. And this one, breakdown, coming up for a near back test now. JNK is obviously a big one, junk bond, corporate junk bond ETF. And again, as mentioned last week, breakdown, hit the 200 days. Nothing goes down forever. Kickback rally, probably another leg down coming. And this is important too, because junk bonds trade much, much more closely and in line with the stock market, with equities, than they do depending on interest rates. So they can trade a lot different. And that's what we're looking and waiting for, to see that separation or divergence between treasury bonds and junk bonds. I'll call that the widening of the credit spreads. LQD, corporate bonds, very, very important one also to watch. And this is your uptrend line right here. Has divergence. Divergence isn't a sell signal, but if you go down, when you see a little level like that, you can go down to the 60-minute chart, draw yourself a trend line there, and say, okay, so there's our 60-minute chart. Little minor trend line, that's the one I was showing you on the daily. If that breaks, that should take us down to, we've got a little bit of price support. It's been a while since I marked up this chart. Either way, one to watch. All right, I think we're about finished. I already gave you TLT. TYX is the yield on the 30-year bond. And what you can see here, got a little line of trend, a little wedge right there. Nice divergent low. This is the first divergent low that I've had here on the daily chart of TYX since back here. And we had one right here. That was a divergent low. That was a divergent low. And you can see what happened each time there. Got that. We got that. And who knows? Let's see if we get the sell signals on the bonds. BIZD is in my fixed income thing. It's just, again, still a nice exit at that T1. I told you that was my preferred target. We'll watch this. I'm not short it. I'm watching it more for any potential problems in the market at this point. But TNX, the yield on the 10-year, also divergent low, but it's got some, it could come down a little more. And if it does, I'll be talking about this a week or two from now if we extend the divergence like this. Just like what happens on the market and some other things that I'm watching that put in divergent highs and divergent lows. So, all right, so there's kind of your overview on treasuries. Let's move on to natural gas. Let's cover that real quick. So last week, earlier in the week, I had stated that we had, taken out that previous low, reaction low there on the correction after hitting T1. To recap, if you're new to the site, we had a bullish falling wedge and a buy signal was a trade set up here, the most recent trade on that gas. Broke out, triggering a buy signal. Had R1, which we took out, first resistance. I had a line here, R2, and I modified it. That would have probably been during the video, one of the videos. And then we went on to hit my T1. The targets hadn't changed. So we hit that first target for a quick, relatively quick, 15, 16%. Natural gas futures are up a little more. Then we pulled back. And at this point, I told you I wasn't crazy about the magnitude of the pullback, especially when we took out this trend line. And that said, chances are, knowing natural gas, knowing how they work, we'll go down, we'll undercut the recent lows and then reverse. That's what they do. Because if we do, which we did, we would have just take the existing divergences. And then I covered it on Friday, right after it happened, that was indeed a false breakdown. And in that video, I said, okay, that's good. That's a buy signal. Fewer things are more bullish than a false breakdown. Because you get the shorts that jump in thinking that this whole thing is going to play out. Natural gas just put in a new low, and then they start to cover. And so today they're feeling the pain. And in that video on Friday, on that update, I told you it should rip if we are able to take out 1224. Well, they did so in the best kind of fashion, a big old gap above that level. So for those that shorted that breakdown, natural gas has already reversed about 12% since Friday's breakdown, false breakdown, that is. And so now, look, noise within the machine, kind of like the VIX grinding around, very volatile. You still have to, remember, we hit T1. The targets are the best resistance levels, the ones I think have a very good chance of hitting, and they're also the ones that, upon the initial tag, a reaction is likely. However, we're building a pretty strong base here, so keep in mind that if and when we punch through T1, which is $14, there's going to be a lot of energy building. This is like energy building like a coiled spring when you get in these trading ranges. And so we could explode right on through the early targets there. And as I've stated, I may add additional longer-term targets if and when we start to rock up through there and move towards T3 or T4, T5. I may add some additional targets for you. And also, as stated, what kind of slowed down the advance since we broke out. Again, we hit the first target, but this whole sideways, kind of slowish, natural gas, sometimes she just rips once she breaks out. This was a function of what crude was doing. And now crude, as I said, is finally clearly broken down. Crude also was in a trading range, and natural gas traders are waiting to see where crude goes, because when crude prices are high, natural gas production is, or natural gas prices are depressed. And so what you want to see, and we finally got it, this was really nice support. Crude was holding up kind of high-ish, keeping natural gas at low end of the range, and crude has just plummeted with all the peace deals in the Middle East going on, all that good stuff, and that is bullish for natural gas because then they start capping those unproductive wells and it's a gradual thing. The lower crude prices fall. Now you're coming up to really good support, but this has already happened, and that could put a bid underneath natural gas for a while. Unless crude shoots back up here, I still like the natural gas trade going forward. So crude probably a little more downside before they come in and buy it, play an oversold bounce, and hopefully that'll give us the catalyst to let natural gas break out above that first target and run on up. All right, we're at the 34-minute mark. Let's just cap this one up here. I'm not seeing much else today. Like I said, I'll get back to QQQ. Just to say what I said last week. These were my kind of zones. I said, we'll trade by colors here. I'll give you these purple shorting, objective shorting zones. This was a level that anything above was my no-go. No more shorts. You can sit tight, especially if you took that short entry. Let's say you didn't cover profits. We hit that second target on NQ futures. That was right here. Yep. There's NQ futures. I gave it to you. There was the trend line break. We hit my first and second. Those are only labeled targets I had for you on that chart. These are all other potential targets, but this was the kind of no-go zone, and we're back above that now again. But we still haven't taken out the previous high, so we haven't taken out that bearish engulfing candle. And this was the area, again, that will be an objective short entry. It depends whether you are short from here or whether you are long here and you're looking to game a bounce and get out. A back test of the trend line is always an objective short once you break down. But the problem, you can continue to back test, but it is an objective short. And what you want to see if we do go on to back test is an impulsive rejection off that level. And very much important to me would be to keep those negative divergences still intact. And we still have those very much on the weekly, daily. Here's a weekly chart. Big divergences still intact right there. Okay, so just know that this week is, I think we probably stalled out for today. I think it has all the making of a trend day so far. We've started up, we're moving up. Maybe we continue into the close. Again, stops, in my opinion, are going to be, for me at least, held off until Wednesday to see how, through Wednesday, because Tesla and I think Intel report after the close. I'll have to check on Intel. I think it's Wednesday also. And we'll see where we go from there. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.